right, so welcome everybody once again to our weekly discussion. So markets have been pretty interesting in the sense that we have seen quite a bit of recovery. And I would like to get comments from people after we talk about this session. But basically, the mood has been, in general, what I'm hearing is people are getting more and more hopeful of market recovery. So now let's look at, I think our agenda today is, first of all, means we are right in the middle of earnings season. So we can talk a little bit about that. But before that, let's have a quick look at the charts. Last time when we joined the call and we discussed, we were talking about how the bounce from this strong support area was great thing because we did not break. Structurally, the market did not break. It can still be called a correction from where we can come back. And this bounce sustained significantly that we have also made a higher low now. So after making a higher low, I think for intermediate term, the trend has turned upwards. That's where we are today. Of course, we have quite a few hurdles upcoming. We have a 200-day moving average to test, and also the previous low, the first reaction to this whole trade war, where we had bottomed out. So neither of these, so these are the two levels which we will be watching. We are sitting at that first resistance, and the next will be the 200-day moving average. But again, what is driving it? I would say there are two factors which are happening. One is that we are seeing very significant change in the narrative where Trump has taken a step back on the escalating with China. So, which was actually kind of expected. I think we had talked about it that this is all a negotiation tactics, and China is not baiting either. So they are not ready to come and take a first step. In fact, they are rejecting all the notions of that we are negotiating. They are willing to take it all the way. We will discuss more in detail on this, but if people have any questions, but I think my view is very simple that US has been looking at China as the main conflict partner in this whole trade war, and China is saying, okay, we are ready for it. We are not. This is not like Trump's first term, where China was still tentative. They're saying we are ready to prove, and we are going and looking for alliances to actually stake the claim for the superpower, which they believe they are. So I think that's where we are in the geopolitical scene, and which is what I think market is now keenly waiting for. In the meanwhile, I think what we are seeing is the earnings have come in really great. I think Google has, let's have a quick look at Google. I think it did bounce back quite a bit. But overall, what I would like to say is that it has been, like I would say, one of the very good results. They have not given any negative direction. They did not comment much about the impact of what is going on right now. Increase the buyback, increase the dividend. So all the good things. The advertising spending is good, which was actually a positive sign. And because of this, you saw that other related digital players like Meta and all have also bounced back. So this is a great sign from an earning perspective. But going back to macro, let's focus a little bit more. The other thing which I think we have been, if you are our subscriber on All Access, we are also talking about, how there is a silent QE at work. So what is basically happening is now the Scott Bessent has been giving a lot of interviews in last 1 week or so. He has given a couple of talks, and they are pacifying the market by multiple different approaches. One is, of course, Trump was keeping pressure on Powell, which is more for a theater, I would say. It is just to show and that I want lower rates, but in reality, that is not something Trump can control, or neither market is ready for him to go and fire Powell. So what is happening now is Scott Bessent is taking the indirect approach, where he is indicating that you can go and manage the yield curve by doing buybacks. And I don't want to go into too much detail of that, but basic idea of buybacks is that wherever there is a issue with liquidity in a certain section or long rated bonds, you create the indication that you're going to buy. Market front runs that because market is looking for that buyback to come in. Market actually starts chasing for deals, and the yields start coming in anticipation. So that is a very easy thing which Besant can do. Yellen had done it in 2022 and before in 2018. There have been a lot of instances how Treasury has done it without help from Fed. And that is what is showing in the 10-year yield. If you see that yield is dropping. So this is the ultimately what it means is that we are again in indirectly we have already done QT almost gone to zero, and we are doing a silent QE by also relaxing the bank liquidity rules and so on. So overall, we are in, you can call it in a stimulus market. And as I was talking earlier, like we had a presentation to some institutional investors, and this is one of the slides I was showing. Like we are ultimately, what is the asset prices? Asset prices are mostly a result of where you are in terms of um, what is the total money supply. And we are looking at now, this is, by the way, just to give you a context, this is the US money supply, Japan, China, and Euro. And this is last 5 years chart, where we all know how much money printing was done by US in COVID time. And then we, since 2022, we have been going shrinking. But you can see now in last 12 months or so, we have again come back to the peak money supply. Japan had been also doing the same, and China is in continuous printing mode since the COVID started, and they have not stopped. They had their own real estate burst, and now they are increasing their deficit target because they are looking at trade war to be fought. And after I think the contraction from euro side also, they are accelerating because now they have to increase their defense spendings and so on. So overall, what we are trying to highlight here is that fundamentally the macro tailwinds are coming, while the trade war is more or less, people have seen the worst case scenario. So it's, in general, we see there is a lot of positive in the market. As we already saw what happened with gold, because of this M2 money supply, because there were concerns on the equity side, most of the money supply was going into gold. And now there is some correction in gold because equity market is back in favor. So this kind of correction is not a change in direction, I would say, in gold. It's mostly money getting allocated into equity. And that is very visible in how fast some of the tech stocks are moving. And also Bitcoin. Now, this is something which we have talked about. I think we talked about last time, the breakout. And as you can see, last week when we were talking about it, we had not yet crossed 200 moving average. So we were talking about how this is the only test remaining. And now after that, this candle, you can see the whole technical breakout works out. We were already broken out. We had only one resistance, and then we cleaned that up. So this is where I think most of the kind of money supply impact is seen, where you are seeing all kind of asset classes, whether it's Bitcoin, whether it's gold, whether equity, all of them are getting benefited. Of course, this is usually impacting, money supply usually impacts medium to long-term trends and not day to day. So market still reacts to day to day. So I'm not suggesting there won't be any volatility. I'm not suggesting that we will not see corrections. What I'm trying to highlight here is that in general, there is a tailwind. First, we saw gold breaking out. Now we are seeing Bitcoin breaking out. Now it's a matter of whether we can clear out the equity problems, like whether we can get trade deals, whether we can get some progress on the tax bill, which we have been talking about for last 3 or 4 weeks. There is a lot of positive news flow, which can still help equity. And most importantly, as we said, we are right in the middle of earnings cycle. We have already seen good earnings from Google and Netflix and so on. Except, of course, Tesla is an exception because of but that was already baked in because the delivery numbers were already out pretty much at the start of the month. So market did not market actually reacted positively to rest of the news. So overall, I think we are seeing a pretty positive market sentiment right now, and that's where we are at this stage, waiting for either positive or negative news. I would say next few days, earnings cycle will determine a lot of response of the market because next week is full of earnings. And then we have, of course, very soon in May, we are here looking for Federal Reserve meeting and where Powell is heading. Um, I would say the things to watch out would be to continuously look at how bond market is continuously holding up, because we do want bond yields to stay cool. That would help the macro push. And other than that, I would say it's a matter of news flow from trade deals, from tax bill status, whether we can move it fast enough or not. So that's my quick take on it. We can take questions and we can enter into the discussion from here. Let me just stop sharing here. Yes. So I see a question. I don't see any question. Actually, there's a comment. So yes, there is a question on the chat. Foreign investor and institution have taken money from US equity to other markets. Do you expect them to return back to US equities? So I think, again, this is a very interesting thing. And I had shown this chart before to in fact, part of our institutional presentation. This was a question which came up. And I always talk about foreign investors. These are like, when you look at most of the news flow, unfortunately, is a day to day. Nobody is looking at long-term trends when they are creating the news. So yes, there is usually a reaction. Like, people tend to, when there is uncertainty, which was the trade war created the uncertainty. So people do tend to exit for some time. But I think long-term trends are still pretty heavily in favor of US equity. So let me show you one chart which I showed there. Now, this was the US allocation. This is like, 75-year trend. As you can see, the foreign ownership of US corporate equity is rising at a very fast rate. And this is percentage, by the way. If you look at the size of the market itself, that is gone 6 times in just 16 years. And so it's almost going exponential, the US total stock market capitalization. And within that, the percentage share of foreign ownership is growing like crazy. And there's almost every country you can put your thumb on the map. The equity ownership has only grown in last 25 years. So I would say these are long-term trends, which is not going to change. And if whatever you're seeing, whether the market is, there are some exits, those are mostly probably people moving out into short-term into gold or some other safe havens, because they just want to be in cash for uncertain periods. And definitely, I'm not concerned about for any kind of any money. Forget about foreign money, whether it's domestic money, institutional money, whether it is foreign money. It will come back, because there's nothing better than US stocks. Like, what country or which asset class gives you the kind of growth, the what we are seeing with tech players, like, what we have seen with Nvidias of the world and Meta, Google of the world. Means you're talking about AI being the leading trend. You're talking about all the development in what we talk about, like in robotics, self-driving. We're talking about pharma with all top 10 companies of the world. The fastest growing companies are in US. We talk about any field. I think other than, of course, we are talking about this bipolar world where China is catching up on a lot of things. But in terms of open markets, US is the only place. So I don't think that will ever be a concern, that whether the foreign money will come into US or not. It's a matter of, yes, short-term uncertainty did create some kind of outflows, but that is not going to be a long-term trend in my view. Then I have see a comment as China has contradicted Trump and said no deal is being discussed. Yeah, I think this is a great point. So maybe, Naresh, you want to say more about it? Feel free to uh, comment about it.
More is that either yesterday or day before, Trump said we are negotiating with China and tariff won't be what it is, and market went up. But then China in the morning yesterday, CNBC said they said no deal is being discussed. So, of course, one of them
Mhm.
truth. It's hard to know which one or who.
Yeah.
Regardless of that, I think going forward, do we still have any surprises left, which could
Yeah.
set the market up or down like we saw in early April?
Yes, I think there is definitely we are entering a standoff period between US and China. So no question about it that we are in a period where we are seeing that uh, even though Trump has backed down, which market is celebrating right now, um, market is right now discounting whatever China is saying, because the belief is China will play hardball because they want to be recognized. They want to be recognized as a superpower now. And because the way Trump has openly escalated this trade war with China, they cannot step down either. So just like we have Trump as a personality, we are now dealing with a superpower, and Z is like, going to do that. Now, on the other hand, what is the reality? Let's talk about this. Like, China cannot afford standoff for very long. As we discussed, if we looked at the money supply chart of China, they have been in a continuous stimulus mode. The reason being the COVID they had not even recovered from COVID lockdown, slowdown. Their confidence in their population consumption, the domestic consumption has been dented for two reasons. One, first, the COVID came. because of COVID, there was a huge real estate crash, which is worse than what we have seen in US in 2008. So currently, China is going through that recovery period. They're stimulating that part of the economy. And as you know, like, you may know that Chinese investor, most of them invest very heavily into real estate. So all of them have been impacted, and they are in a very negative frame of mind for quite some time. So the domestic consumption was going down, their population is going down. So they are in a pretty tricky situation. If they do not recover their exports to US, there is no other way they can survive in terms of their economy size. So market knows it. I don't think anybody is worrying about China not coming to negotiation table. They're just playing hardball because they don't want to come on Trump's terms. They want to negotiate as equals. And I think that is what we are going to see.
I see.
Now, but in terms of surprises, yes, there is one more surprise remaining, and that is uh, we had, when we initiated this kind of tariffs, when Trump started on April 2nd or whatever, April 9th, whichever date you can take, where China was clearly almost like a blockade, where you said no more ships except expected. No, nobody's going to take a delivery at 100%, 135% or 45% tariff. Now that blockade is still there. And now they are talking about reducing that. The reason being because a ship travels from China to US, it takes 30 to 40 days. Whether it's West Coast, it's 30 days. If it is East Coast, it takes 40 to 45 days. Now, by next month, we will know, what are the issues in terms of deliveries and what contracts were canceled, what orders were canceled. Because and also we are still happy with, because of the, everybody was expecting the tariff, so there was a lot of stockpiling. There was a lot of front running. So I think why Trump is desperate now to discuss with China is because he knows that he cannot afford inflation rise if we have a COVID style supply shortages, which is definitely going to happen within a month if this issue is not quickly resolved. So this is why I think you are seeing Trump and Bessent, they're trying to cool down the market. They're inviting China for negotiations. And I think now it's a matter of how much pain China wants to inflict on US. And that surprise is still there. Means maybe China is saying we have taken enough pain for the last 5 years and we can handle another month or two and let US suffer. So that can be a strategy which China can take. And definitely that will create some negative news cycle in US around May timeframe, when we will start seeing supply shortages and so on. So that is what I think we have to worry about.
Thank you.
Okay, let's take some more comments. So there's no such news of a trade deal with countries other than China. Uh, I would say not exactly, because what is happening, like for example, India has signed a deal with the US, and when I say deal, of course, the trade deals take years, so some definitely have many months. So what they're trying to do right now is they are trying to create a framework. So India has actually already announced that they have agreed on a framework, and what Trump administration is doing is they are going to create a broad, as we call it, as a term sheet or whatever you can call it, and they will start exempting based on those broad terms. That's the model they have gone with Italy. That's the model they're going with Japan and India. So internally, I think the news flow is right now pretty much positive, where each of these deals are being structured in multiple phases. But I think, as we already know, that there is a 90-day pause on the tariff for almost everybody. And within 90 days, most of them will end up negotiating some kind of a structure to extend these exemptions. That's the market expectation right now. But yes, if any standoffs happen, that will create a problem. For example, if and again, this is let's again go back to this theory, right? Means we are in a bipolar world now, where there are more aligned countries with US who are going to come and negotiate. There are more less aligned countries who are going to take a more tough stance, which China is taking, and China is also pressuring some of their allies to take a tougher stance with US. So there is a lot of push and pull going on, which is we are in a deep Cold War status right now, you can assume, and that is where I think the negative news flow can come, especially because EU and some of the bigger players, like I think most of the bigger players are already clearly aligned with US, like Japan, Korea, India, Canada, Mexico were already not part of the reciprocal tariff because they are part of the North America Treaty. So only I think big player we are talking about is EU. And within EU, I think countries are taking different approaches. We have heard about Spain and France talking against US, while Italy has been very forthcoming and doing a deal. So it will be interesting how EU plays out, and I think that's where there are some uncertainties which will play out in next few weeks. But I think overall, market is discounting all that because the big issues are resolved. And big issue when I say is purely that Trump was talking totally nonsense when he was doing this 145%, 135%. So once they have taken a step back, market is now coming back to the April 2 guideline. If you remember, before April 2, when we had this call, we talked about everybody thought that means it will not be as bad as Trump came out with. And because that was insane what he did for a few days, but that was also everybody knew it was a negotiation tactic, but it created a blockade, it created a bad situation. He escalated basically the war, trade war. But I think we are back to now where we were on April 2, where people are now in that situation where they're saying that there will be negotiations, there will be definitely now Trump has achieved, as some of his cabinet members are claiming victory, that because of all the tantrums which he did, now the deals like 10%, 20% tariff will look like a deal to everybody, and people will take a sigh of relief. On the other hand, if he had started from 20% tariff on April 2, everybody would have complained. So this is their way of declaring victory. But now, again, we can all question his way of doing things, but this is where we are. So overall, what we are trying to say here is that uh, there will be uncertainty, but in general, the worst case news is behind us. In general, market is now focusing on other things beyond the worst case trade war. People are looking at earnings. People are looking at potential tax cuts. But people are looking at how there are other positives. Like as I said, that macro trade tailwind is already there. There's a lot of money sloshing around. There's a lot of money printing happening. So it's a asset prices have a higher chance of going up as long as there is no big negative news flow which comes in. So that's where I think we have to watch out. Let me see what are the other messages here on questions. Crypto stablecoin adoption is growing. Any good investment add to portfolio? So I think we usually don't discuss portfolio here. This is an open call outside for non-subscribers also. But I would say, in general, I think the Bitcoin is leading in crypto world. We have discussed multiple times here why we don't believe very heavily into allocating big time into smaller coins, but we will see the spillover effect of the enthusiasm in crypto market. So there may be altcoins may do great in the current environment. But again, my view is very simple that Bitcoin is breaking out technically as well as I'm sure people are like, and I think if you are a subscriber, we already sent out the messages earlier where we talked about how the corporate treasury game theory is playing out. We beyond MicroStrategy, we had a GME. Now we are looking at the new entity 21, which is going to be one of the biggest entities because you're talking about the Tether and Bitfinex and SoftBank. These are like really big players, and especially Tether being one of the biggest, winner in the stablecoin space in last 10 years. They earn so much money that they are actually so relevant today that almost every country's treasury is looking for them as a customer. Like they are going to become as big as China, just using the USD as a stable coin in terms of buying the treasury amount, how much amount of money they have in terms of the treasury assets. So yes, I think stable coins are going to be impacting this economy, but I would say that the biggest beneficiary is again going to be Bitcoin, because somebody like Tether, whenever they declare their earnings at the end of the year, they are buying Bitcoin. So everybody in this world, in stablecoin world, whenever like the kind of earnings these companies are making, they're parking it in Bitcoin. So I think there's nothing better than Bitcoin if want to be in crypto domain. And if you're a subscriber, we are also explaining how to benefit from rest of the things like MicroStrategy, like Bitcoin ETF and the options and so on. So, but I think the strongest flow and strongest growth is going to happen in Bitcoin world. Um, I would not comment on other crypto coins because it's very tough right now. I think the way market is behaving, like the way we have seen the altcoins underperform. Usually they will be the last one to go up. And I would, and we have been telling everybody to keep moving away from altcoins and enjoying the benefits of Bitcoin right now, because that's in a kind of a secular up move and really displaying the digital gold narrative right now. Coming back to other questions, I see anticipated growth for 2025 was around 10% before tariff. Even if we assume 10% tariff across countries, can we still have 10% growth? I'm not really sure which growth we are talking about here. Is it the market upside move? Because definitely it cannot be the GDP growth. I'm assuming the question is about the market move upwards. So again, it's very difficult because after the kind of correction we had, I think most of the research and analyst firms have downgraded their S&P 500 targets for this year. So I think people usually whatever they start with in terms of what are the targets for 2025, they have been revised. And I don't usually pay attention to most of the analysts because I've not seen ever the consensus analyst estimates ever met by end of the year. Usually either they undershoot or they overshoot. So I would not be worried about it because I think the way capital markets are changing these days, we have to take stock every quarter, we have to take stock every month. And I don't believe in giving out targets either. For individual stocks, you can give out targets but for the market, it's very tough. But I think as we discussed at the start of the call, the macro tailwinds are pointing to risk asset going up, unless we sabotage it, like what Trump has been doing for last few weeks. I think after all that is behind us, hopefully in over a few months, and if we go back to whatever wins he wants to achieve in trade deals, what I would like to highlight is that now we are back to normal trade war. We are not back to blockades. So remember the level of April 2nd tariffs which were announced, they were purely blockades. Nobody would have shipped at those tariff levels. Now we are talking about more moderate. First of all, there is a delay of 90 days. Then we have more negotiations happening. So what that would mean is that is we are this we have seen before. Like if people are forgetting that we had a lot of tariffs applied in Trump first term, we had a lot of tariff added by Biden. This adding tariff has been happening for last 6 or 7 years now, and it is not a new thing. And so this is something which market can easily navigate. So I don't think it's a big headwind anymore, except for the unknowns of the China-US trade war situation. So overall, I think there is the bigger picture narrative has been resolved for the worst case. But in short term, because we have done enough damage in the market with a 20% plus correction, now it's a matter of whether we can recover the confidence. And individually, I think some stocks are already making a new move. And we are already seeing, some of the asset classes like Bitcoin and gold outperforming. So the tailwinds can take us to new all-time highs very easily if these hiccups are resolved. And I've been a strong believer that what Trump administration is doing is they're front loading all the bad news. And now we are yet to see the tax cuts. We are yet to see the other good news. So I think that would be the narrative which can take us back. But it will be volatile because the way Trump plays is not good, conducive for the market. The way he keeps changing, the way he makes random statements. I think all those things are a problem for the market, which is what I think we will see discounted for some more time till we know exact direction of this trade war. But again, do clarify if I covered the question on the 10% growth. I'm assuming it was about the market you were asking, and not necessarily there is no other thing I know which in economies are growing at 10%. All right, so I think we can take more questions if somebody has, but I think overall, it's a pretty much a situation where we are looking at what are the outcomes now. I think we did talk about earnings next week, which is going to be crucial. I think what I'm going to talk about is what was leading this bull run. It is the AI trade. We were leading, and I think there was a comment which came out from one of the, I think, AWS executive, that they are seeing strong growth in the demand and they are not slowing down on their spending. We will see when the earnings come out on their capex and so on. Google has not significantly cut any capex, so that's a good news already. And now we are going to look at where we see the impact on capex. I think every quarter we have for the AI side. I think that is a very good sign of the confidence level of hyperscalers and some of these tech players. So I think that would be out by next week, so that can give us some idea. Then I think, of course, Google has also shown us in the Google earnings that the ad spending is pretty solid. So even though we had all this discussion around consumer confidence being low and all kind of economic indicators, which are mostly soft data, if you say, like we have been talking about it every week, that most of the hard data is very solid right now on economy. Only the soft data, which is the perception, the polls, the expectation of a bad future, that's all it is right now. So if that, and that can change very fast, by the way. The sentiment is already turning. We are already seeing stock market going up. We are already seeing people taking a sigh of relief. So soft data can change, and as we discussed in the start of the call, there's a lot of levers being pulled by Treasury to keep the interest rates down in the longer end of the spectrum, which was the biggest concern. So I think that tailwind is also going to be very crucial for how we see the market perform in near future. So I think now it's a matter of taking day by day how we see the earnings, how we see the specific positive news cycle play out, and whether we can take down those technical levels. I would say that is the game. But in general, I'm still personally believing that the worst case is behind us, except for something unexpected, which of course nobody knows. So I think that's where we are. I don't see any more questions. If or comments, I would give it a minute for people to speak up. You can enter your comments in the chat, or you can raise your hand. Right. I think we have quite a big audience today and no questions. So I don't think I have anything specific to present right now, but I think overall I will open it up for maybe if there are no questions, maybe comments about how people are feeling and what are their comments about the current markets or so on. You can unmute or you can come on the, comment in the chat. So I see another message here on Tesla considering lower earnings and sales drop. Do we need to hedge Tesla with? So I think again, this is a very state specific thing. Means if you are a subscriber, we can discuss it in the Discord also. But overall, I think Tesla is a stock which it runs on sentiment, and it has a lot. Means it can go up a lot also. So I would not be means commenting right now on specific trade because it's an open call. But overall, I would say it's market has been uh, driven by a lot of liquidity. When you look at heavy put to call ratios, and when you look at such a negative sentiment, just the short covering can take a stock very high. Remember that. So those kind of things are definitely a play right now in the market, and we are watching that very carefully. But overall, the size of moves will be big in either direction because of the heavy leverage which we have seen previously. So that is the only comment I would make right now here. Yes, I think Naresh, you have a question.
Yeah, actually a comment.
Mhm.
One is market has its sort of a natural forces or its own mind of doing things, as you mentioned, different factors acting. I think other one is some market makers, people with big bets or big money, right? In the old days, they would corner a market in silver or this or that, different things. I think they're deliberately increasing the upswing, downswing to, to really create an entry point for themselves, right? So people who may have missed Nvidia's rise or Tesla's rise, they are, so there is some sort of a fear kind of environment generated. And, I was in India when the last swing happened 3 weeks ago in early April, and I was glad I was sleeping through it. and in the morning when I'll wake up, I think it's 1,000 points up or down. But this is a kind of a thing which separate men from boys in a market like this, and this is not a time to fold and run, right?
Yeah.
To Because otherwise, the whole idea is to buy low, sell high. So if you have cash, this is a good entry point. But even if you have already invested, I think just the staying power is what is needed, is what I feel. The storm will pass, and people who can hang in there in the long run, they will come out ahead. That's my feeling.
That's a great comment. And let me just not say, when, okay, markets are becoming bigger, means I personally don't think it's easy to manipulate at that level. And also the way the regulators have worked after the past instances, it's difficult. But let me put it different way. Whatever the same thing you're saying, what happens is that market is over leveraged. Like we have very excessive movements because we had discussed this even in our investor event. If you remember, I think we had this discussion that when you have a 3 trillion company, you don't need 3 trillion to move the market. You need only 50 billion to move the market. And especially when we have a kind of a thing which Trump did, which was like nobody can say it's a great moment, right? So when you have no buyers, the moves will be bigger. The price will drop even without any big selling happening. You can sell $1 billion worth of stock and you can crash the market by $1 trillion. The reason being the order books work like that. The price is only the last traded price. It's not about how much money went out of the market. So we did discuss in detail on the investor day. So I think what we are seeing in the market is huge, like the news cycle itself created by Trump is highly pessimistic and highly optimistic at one every other day, which results into a day when there are no buyers, or when it results into a day when there are no sellers. And this is why the price moves are bigger. So I won't necessarily call it as a market manipulation, but also the market mechanism. When you have these kind of moves, when you have this extreme pessimism and extreme optimism, that's when price moves are bigger, where the actual money flow is pretty much very small. And it's a simple matter of the order books being very thin on one side, and we call it as an imbalanced order books. And what happened with now similarly what happened with Nvidia, like especially let's take an example. Now when this whole China news came out, if you look at the actual volumes, it was very low. Not a lot of money sold, but the price crashed when when they announced that they will take a 5.5 billion hit on their quarterly earnings. Now these are the kind of scenarios which can get reversed very fast, and that's what we are seeing right now. Means that day, whatever drop happened, Nvidia has recovered already. So all kind of market movements today are means they also give, and the first part is of course the thin order books. The second part is highly leveraged people. They have to unroll very quickly, because market participants are there are so many derivative instruments. Now we have stock specific 3x ETFs, we have stock specific 2x 3x kind of ETFs. So everything has become over levered in this whole market. So this creates excessive moves. And you have said very well, Naresh. I think the very, very important point is that if you react to those moves, and if you're not looking at medium to long term picture, you can lose out. And we did present it also in, I think, previous calls. We also have posted it as a separate clip. Like if you sit out, that's not an option, because if you sit out, most of the best recoveries happen during the bear market. Most of the big what happened on April 9th, when we had this whole 20% move up on almost all stocks. That kind of move you will miss out if you were waiting for it to settle down. And since then, I don't think we have even recovered to those levels again after that one day move. So if you came after Trump reversed that, which happened within a matter of minutes, you already missed out on the biggest move of this cycle. So this is where I think it's definitely it's a matter of looking at more medium to long term, and making good selection of stocks, and looking at whether fundamentally anything is changing. And this is what we are continuously discussing for sure. I do see a couple of other questions here. One is on SMCI. Any thoughts? SMCI has fixed their financials. Any thoughts on why it dropped back? I would say SMCI has been a high beta stocks. It did hit its issues with all the financial reporting, but also you have to understand that it's part of the AI trade basket though. and they don't have any special thing, in terms of, any moat. Where means if you see now that there have been they are competing with Dell and other players who are announcing bigger and bigger deals. So it's their margins are not great. So they are part of the AI trade. So I think the pessimism and optimism around the even any negative news on Nvidia also hits them. While Nvidia itself is vertically integrating, they are reducing dependency on all these external players. So I think we can discuss specifics. I don't want to go into that right now, but basic idea is that there is no easy uptrend for players outside, who have the moat, like Nvidia has a moat, or somebody like Google and Microsoft in AI play. So all these stocks, I would say you should trade opportunistically. They are not clear winners either, even if the AI is successful, because of so many factors going in favor or against, beyond the issues they already faced, which was a big issue of their financial discrepancies. So I would say it will probably continue behaving in the AI trade manner for now, but like wherever the AI trade takes it, and also specifically on their earnings, it will react mostly on where the direction it is formed. I think the next question is on the gold. What is outlook for 6 to 12 months? I would say, means we have been talking about gold in almost every previous call, and we have been very bullish on gold since last year. So in terms of now, and I think if you are our newsletter subscribers, we also hedged our gold earlier this week, because we did see there is a potential correction, and this is what is playing out right now. But I think, yes, 6 to 12 months, I think gold is still bullish. Whether it has a lot of upside left, it's difficult to say now, because it also depends on how much stock market uncertainty is removed, because gold was accelerating when there was a safe haven investing happening, and market was moving out of equity and allocating to gold. So there is some money flowing out of gold right now. Definitely, it is still in a long-term uptrends, but in terms of the pace of growth, it may grow or slow down based on how uncertain rest of the world is, in terms of equity market and so on. But I think at this moment there is nothing changing, because remember that what is the biggest demand for gold is coming from the sovereign national reserves, and China is still sitting on very heavy USD allocation. The belief is that even though they are not selling aggressively, they are going to not renew it. They are going to let all the US debt expiring, just let it expire and continue buying gold. So that's the expectation. So I would say that there is a tailwind for gold. Same thing because of money supply, which we discussed at the start of the call, which is growing. So I think gold, Bitcoin, all these things will do great. But I think across these assets, I think gold has already been sitting on a pretty huge run, like almost 70-80% run in last 12 to 15 months. And it becomes a little challenging for something like gold to sustain. Like we cannot expect another 70-80% run for sure. So let me put it this way. So we are in the last phase of the gold bull run. Whether we make a top at 3,500 or 4,000 is very difficult for me to comment on. The trend is definitely upwards. It's not reversing, but it may not have as much upside as it was with last year. I would say potentially another 20% is definitely on the table. Maybe we can also, best case scenario for me is right now is 4,000, where we can hit. But I think right now, technically, I would say we have to see if it can sustain above 3,300. Then I think it will look pretty good. But yes, there is definitely tailwind on all the hard assets like gold, Bitcoin, and so on. I see other question on if one is holding SOXL and SPXL, is it good idea to hold? I would say, means again, these leverage plays, I usually recommend against holding them for long. They are great trades for a few days when you are playing 3x leverage, because if the market is volatile, if there is a huge correction one day and they go up next day, they're not going to behave like 3x, that's for sure. They lose out a lot because of these, churn up and down. So if you bought it at a drop and it's in decent profit, I would recommend not holding for long, because if they were great in one-way moves, they behave very bad for the investor if you see more churn. And with the way this trade war is evolving, the way I think we are still stuck with this, the whole up and down with the US and China trade wars. And remember, semiconductor is stuck in the middle of pretty strong views, like, because this is now, it's like oil now. Semiconductor is considered as the most critical part of the national security discussion. And that makes it very tough in short term to predict what will be the comment tomorrow from Trump on, something like Nvidia or something like, what new bans they will announce, because China is playing hardball. So Trump can go back and say more things about blocking everything and so on, which can lead to a correction. So I won't recommend holding, leveraged ETFs in these kind of environments. So you can trade them in and out, but they're definitely not a buy and hold kind of investments. I would rather suggest you build your own leverage by buying some kind of, uh, call option or, call spreads, which you can control better. All right, let's take a couple of quick questions now. We're almost at the top of the hour. So I see small and mid caps have been lagging SPY and QQQ for the last few years, and the trend seems to be continuing. Yes, when would this get attractive? So I think it's a good question. So to be frank, there are two problems. So why, first of all, let's understand why small and mid caps have been lagging, and we did discuss it quite a few times in our investor events previously. It was all about interest rates, because most of the small and mid cap, they are not, why are they that size? And most of them are, you will see the characteristics of these kind of companies are that they are not, they're growth companies, they are not generating heavy cash, they depend a lot on debt and basically cost of the capital in the market. So since 2022, we are sitting in a high interest rate environment, or earlier it was a rising interest rate environment, and then we are sitting in a high interest rate environment. And that usually doesn't work well for most of this sector, most of the small and mid caps. And that there was a hope. I think we saw very good performance in small and mid cap when we started cutting rates, when Fed came out all, guns blazing, cutting 50 basis point in September last year, and we very quickly cut 100 basis point. We saw a rally which did not work out, because then this whole ever since Trump won the election, the narrative changed, and now we are back to higher for longer. Fed is already talking about impact of trade war on inflation and so on. So we are basically stuck in this high rate environment, not as high as last year, but still we are relatively high at 4.25. And I think till we see a clear path for lower rates, we may not see small and mid cap recover. But having said that, I would say because of the trade war also, like most of the impact of the trade war is also on these small and mid caps. So I think if we may have seen the worst, but the reason why the index, the mega caps, they lead is because of their continuous dominance. Like we are talking about Google's, Meta, Apple, these kind of companies who are neither care about interest rates because they are cash churning machines, nor they have their impact of trade war definitely is visible, but now we are seeing that is resolving. So market prefers that. And I think these are dominant players who have the better benefits of the macro tailwinds. Most of the global money also, when they come in, they don't care about, these are the global brands we are talking about. People come to US to invest into these top tech companies, not into mid cap and small cap. So I think unfortunately that is how the world is evolving, where larger cap, which dominates these SPY and QQQ kind of indices, they will continue to dominate, because means because of the information availability being so widely available on these stocks, that most of the money allocation goes into that. And the way these indices are designed, they are weighted by market cap. So there's this whole exponential effect of more and more allocation coming into these stocks. So unfortunately, this is how it is. And I don't expect in long run this to ever change. Um, Unless, of course, there will be a time period where the interest rates are again going down very fast at some point. And that will be an opportunity again to see small cap and mid cap outperforming. So again, it's very difficult to say, because to be frank, right now the Fed is delaying the rate cuts. They are indicating that they're going to wait out the trade war impact, which will be pretty important to follow up. Like I think that is going to be the next question on the macro. While Treasury is doing the silent QE, while most of the world is printing money, I think the only thing remaining now is how fast we can get Fed to soften up and become dovish. And that is why I think market may react. First of all, I think again, just a summary, next week earnings will be crucial from a narrative perspective, whether all this trade war uncertainty or whether any of these things have uh, solid impact on how the capex is going, how the outlook is going from some of these big tech players. That would be one thing to look out for. The second would be for Fed meeting and FOMC meeting minutes. And I think we also are going to see very soon what is the expectation of, means if they are indicating a rate cut, because market is expecting 2 to 3 rate cuts at least. At one point, we were expecting 4 rate cuts this year. So I think that kind of discussion, I think we need to have, which will give us better indication of what are the other tailwinds remaining. But I think the good news is that the hard data is good. Like whether the inflation data, whether it is consumption data, most of it is looking very solid right now. So if the soft data, which is the sentiment, can turn around, we can have all-time highs all over again for everything. So that's my view. And of course, for that, we need some kind of resolution on trade war, which can drag on for a very long time. So that uncertainty is still hanging on us. So we have to play by the ear and see how next few weeks play out, next few months play out. And my view is that second half will be definitely much more clear. Either we would have recovered by then in this year already, or we would at least have some visibility into how the markets are going to do for the rest of the year. So this is where we are, unfortunately. All right, so I think we are at the top of the hour. Thanks for great participation. I think we had good questions, and thank you for joining on a Friday evening. So have a great weekend, and let's talk again next week. Thank you, everyone.
Hey,
Bye-bye.
thanks, Raman, for setting this up.
Thank you. Bye-bye.